Let's talk about China. The Chinese markets had a rough start to the year. What caused that correction?
Chinese markets are usually very well contained, primarily because the Chinese Communist Party contains them. But from the beginning of this year, trading in both Chinese equities and the Chinese currencies trended down in a very disorderly way. It was almost as if the authorities had lost control of those two markets. There were rumors that some of the support that had been given to keep the Chinese equity market from crashing was going to be removed, and there was uncertainty about what Chinese officials wanted to do with their currency. When those were added together, investor risk aversion began in China and spread westward.
So the currency contributed to the volatility. What were the Chinese trying to accomplish?
At first, it was quite a mystery as to what they were trying to accomplish because there was no signal about what the strategy was or where the Chinese currency was going to end up. The Chinese would probably like to see their currency a little bit weaker to promote their exports in world markets, but they have to be careful about letting it get too weak because that begins to depreciate the value of investments in China, and that could prompt capital to leave the country, further destabilizing their markets.
Some would say that markets don't always reflect what's really going on in the economy. Do you see that happening in China?
The volatility that surrounded Chinese markets at the beginning of this year raised new questions about the delicate economic challenges that China is facing at the moment. They're attempting to go from a primarily heavy manufacturing economy to one that is more service-based. That is a very difficult transition to make, even for countries that aren't nearly as large as China is. They're also trying to do all of this without suffering a recession because they would prefer not to have the social instability or market correction that would go along with it. And so keeping up growth while you're trying to make such a significant change has considerable risks to it.
So how do events in the Far East hit close to home?
There are three ways that events in China can come home to the United States. First, we do have important exports to China, but they amount to only about 1% of our gross domestic product, our GDP. So that's fairly minor. China's slowing is affecting emerging markets much more significantly, those that sell them commodities in particular. And when you begin adding those markets together, it has a much bigger impact in direct business with the U.S. But the primary agent of contagion has been market psychology, which finds concern in Asia moving through the trading zones and hitting New York. And so the risk aversion that began in Shanghai hit the Dow Jones Industrial Average hard at the beginning of this year, and that certainly did not give an optimistic start to 2016.